We know one thing for certain. Politicians want that gravy train. They want to stay in office. So we may actually see things get done. Homes went up 40%. We were talking about 15% per year, 10% per year, then 6 and 5, 40%. And we all know your incomes didn't go up 40%. The average age of a first-time home buyer for a millennial is 40 years old, whereas 10 years ago, it was 30 years. Politicians want to keep their jobs, so they're going to try doing whatever they can. And if the average American still thinks things are just unaffordable, they're going to get voted out of office. It's that simple. Welcome to the Real Estate Show with Pat Lopez, where we talk everything real estate. So for this show, I'm going to be talking about 2026. What can we expect? Now, the biggest thing that is going to be the mover of what happens is going to be election year. That is the key, election year. We know one thing, and one thing for certain. Politicians want that gravy train. They want to stay in office. So we may actually see things get done. Now, the big thing, the catchphrase for this year is affordability, okay? And we have this administration just throwing stuff up against the wall, those trial balloons, seeing what will catch, what won't catch. We've already spoke about in the past about assumable loans, about portable loans, 50-year mortgages, but the administration just came out, the president said to Fannie Mae, Freddie Mac to start buying back the mortgage bonds. Now, what is a mortgage bond? When somebody gets a 30-year fixed loan, it gets bundled, it goes to Wall Street, and is sold. And your 401ks, your pension funds, foreign countries, they buy it as a conservative part of their portfolio. So that is what a mortgage turns into, a mortgage bond. Now, what impact would it have by having Fannie Mae, Freddie Mac start buying mortgage bonds? Well, the impact is going to be the spread between the 10-year Treasury and the 30-year fix can continue to come down. Okay, if we look historically, the spread's been around 1.8. Okay, so what does that mean? If an interest rate, if the 10-year Treasury is at 4%, then you would expect, if we're at the historical norms, a 1.8, then the interest rate on a 30-year fix would be 5.8. Okay, and that's exactly what's happening right now. That buyback is causing interest rates to float down a little bit and float down in the high fives. So the interest rates already started coming down, and we were in the sixes, low sixes, but now we're starting to hit the high fives. Now, of course, I always have to preface, that depends on your credit scores, your down payment, what kind of loan you're doing, okay, the loan size. So there's a bunch of moving parts as far as that's concerned, but once again, interest rates have drifted down, and that's pretty dramatic, because if we turn around and we look in January of 2025, a year ago, interest rates were in the high sixes to 7.25. So we went into the spring market with interest rates in the 7%. So odds are, if we can keep these interest rates lower for duration, meaning these rates stay 3, 6, 9 months in the high fives to low sixes, now people can actually plan and move forward. Because the biggest disappointment that I saw with people, they would get pre-approved, and let's say the interest rate was at 6.25%, and by the time they found a house and they were ready to pull the trigger, interest rates jumped back up to 6.75, and now they couldn't afford the house, or they didn't feel comfortable with that monthly payment. So that is one piece of the puzzle. Also, Jerome Powell talked about quantitative easing, okay? What the Fed was doing was called quantitative tightening, meaning they would roll off the treasuries, their mortgage-backed securities. They would roll them off. So as they came to maturity, they would not buy them back. So it would go back into the market, and then somebody else would have to buy that. Well, starting in December, they started buying $40 billion a month in treasuries and mortgage-backed securities, but they were targeting the short term. Now, what does that do? Also helps with the interest rates and that spread. Now, what happened in 2020? In 2020, because we had the COVID pandemic, the Fed went in and they started buying the short-term, the long-term treasuries, and mortgage-backed securities, and they did it like a huge amount, 100 billion, 150 billion a month. It was huge numbers, and that drove down those interest rates down to a 3%. They also cut short-term interest rates basically down to zero. So the Fed does have the ability, Fannie Mae, Freddie Mac does have the ability to cause interest rates to move a little bit, which we'll see what will happen. Now, this isn't a full scale blitz going on like we had in 2020 with COVID, but there are those little steps. And like I said, politicians want their jobs. They do not want to lose their jobs, okay? So they are trying to do whatever they can to have that affordability. And like I said, that affordability is a buzzword, because what we saw in New York, you had a mayor who says he's a socialist. His whole platform was affordability, 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 and people are seizing that and seeing that. Now, affordability is starting to get a little bit better, but it's nowhere near where it needs to be. And what happened, especially with the housing part of things? Well, homes went up 40%, appreciated 40%. We were talking about 15% per year, 10% per year, then like 6 and 5 and so on and so on. So over the past 5 years, the appreciation of homes, 40%. And we all know your incomes didn't go up 40%. So that is what the problem is. So there were stories where you had Realtor.com, Redfin, talking about the average age of a first-time home buyer for a millennial is 40 years old, whereas 10 years, 15 years ago, it was 30 years. So that is a big issue. A lot of people want to buy a house. There's a huge pent-up demand, but they just can't afford that. Now, Totality came out with the median home price of a home, and this is nationally, was $425,000 nationally, median home price. Now, we know real estate's local, so you could have a house in California, the average price could be $1 million, and you could be, in the middle of nowhere, and the house is, $100,000. So it depends where you are buying the home, which is going to determine that. But nationally, the median is $425,000. They also came out and said to afford a $425,000 house, you have to make $94,500 to be able to afford a median sale price of a home. Now, what does that mean? Well, most people don't make $94,500. So that means if you want to buy a house, it has to be boyfriend, girlfriend, husband, wife. So it takes two people to join together to be able to buy a home, okay? So that's where a lot of this affordability, but affordability is still possible. Now, the other thing is inventory is starting to loosen up a little bit more, and it's been loosening up. But we are looking now that people who have interest rates of 5% and higher, between like 5 and 8%, that represents 40% of the homeowners out there who have mortgages. So that means if you have 4.99 and lower, that's 51%. So there's more people as every month, every year that goes on. Well, guess what? The people who had the 2 and 3%, they're either selling, God forbid they pass away, something happens and that mortgage, goes away. And now whatever the, mortgage interest rates are currently, that's where you have. So every year that percentage keeps on going up. And guess what? If you have a 5.25% interest rate on your home, and today you can get a interest rate of 5.75, that's not going to prevent you from pulling the trigger on that. Okay, so that is called, that lock-in effect, and that's starting to ease. So that's helping out a little bit. So hey, we're going to see what ends up happening. Now, with the administration, like I said, there's these trial balloons. They're throwing stuff up against the wall to see what sticks. Supposedly, they're coming out in the next 2 weeks or so, and with a plan of what they're going to do to make housing more affordable. We're going to see, but guess what? Like I said, politicians, they want to keep their jobs, so they're going to try doing whatever they can. And if the average American still thinks things are just unaffordable, things aren't working out, they're going to get voted out of office. It's that simple. Now, the last thing I'm going to say is there's been more inventory coming online, so appreciation has slowed down, which is helping and making things a little bit more affordable. So if we turn around and we look at November of 2024 to November of 2025, appreciation nationally was 1%. 1%. A far cry from where appreciations were at 15%. So at appreciation of real estate at 1%, that's doable with interest rates coming down and being a full percentage lower than where they were last year, and incomes going up around 3.5%. Affordability is getting better. Now, I know you're going to say, Pat, don't get twisted. Things don't work. Things are super expensive. I get it. Things are still super expensive. Affordability is still tight, but it is getting better. So my prediction for this year, 2026, I think we're going to have an okay year. Is it going to be outstanding? No, but I think it's going to be better than 2025, and it should be better than 2024. Tell me your thoughts, what you think of where everything is going, and leave a comment. I always want to hear what you think, and it also helps out the show. Subscribe. I'm at 45,000 plus subscribers, trying to get to that 50,000 subscribers. That really helps me out as well. Now, be sure to follow the show on Facebook, Instagram, and of course on YouTube. The Real Estate Show with Pat Lopez on YouTube. I hope you enjoyed the show, and I'll see you next week.